Hi, this is Greg. Welcome to the channel. And if you're new to the channel, on this channel we talk about business and investment. And in this video, we're going to be talking about the integrated oil business, what it's gone through this year, and how this may be a once-in-a-decade investment opportunity. And specifically, we're going to be talking about Chevron Corporation. Okay, so that's what I'm going to be talking about, and it's coming your way right now. Hey, so 2020 has brought with it, in addition to what I'll call the 𝐥𝐤 that came in, I won't say the word, it's brought with it a struggling economy, and in particular, a precipitous decline in oil demand. This situation has put unbelievable pressure on the oil industry and oil companies in general, and in particular, Chevron is no exception. Now, Chevron is categorized as what you call an integrated oil company, similar to Exxon Mobil. And if you've been following this channel, you know that a couple weeks ago I did a similar video on Exxon Mobil. And so what I'm going to basically do in this video is compare Chevron Corp to Exxon Mobil, and then we'll make some decisions on which one we would go with, and that will come at the end of the video. So at the outset, I just want to say that Wall Street definitely prefers Chevron. Wall Street basically thinks that the balance sheet is stronger, and they like the way they're positioned with respect to their business mix. And as you know from the last video, an integrated oil company is involved in the full spectrum of oil exploration, distribution, refining, chemicals. It runs the full spectrum of the oil business. Now, the first thing I'd like to do to delve into this is I have a very interesting clip from Michael Wirth, who is the CEO of Chevron. I think this basically sets the stage for what I'm going to talk about. But similar to Exxon, the way I'm looking at this, you have two very strong companies here, very strong balance sheets. The real question is, will Chevron defend its dividend going forward, and does it have the financial wherewithal to do that in the face of what might be a prolonged decline or lowering of oil prices, i.e. the commodity? So let's take a look at Michael Wirth, and then I'll be back with some comments. Okay? Take it away.
Hey, Mike, you've said as recently as this summer that the dividend is still a top priority for you. Your dividend's pretty high at this point, 7%, below what Exxon's is at closer to 10% at this point. But is that 7% dividend something that you still consider a top priority? Is it safe?
We've held a consistent set of financial priorities for decades, and we know why most of our shareholders hold our stock, and it's because they count on the dividend. These are pension funds for retired people or people who are headed towards retirement, and they really count on that income. So we've always prioritized that first. Second priority is to reinvest in the business to support the dividend. The third then is to maintain a very strong balance sheet, and the fourth priority has been to repurchase stock when we've got the first three priorities satisfied. We came into this with the strongest balance sheet in our industry. We made significant reductions in our capital spend. We're spending capital at a rate today that's about 40% lower than when we entered the year. And even with this acquisition, we continue to have a very strong balance sheet. So our dividend is secure. We've stress tested the future scenarios at prices lower than we see today, and still have plenty of capacity to pay the dividend. So we feel good about that, and we feel good about the way our people have executed through a really challenging period, and one that still has, I think, some challenges ahead of us.
When you run stress tests on the potential for lower prices of commodities than where they are today, have you ever run a stress test looking at what happened earlier this year where you basically had to pay people to take oil off your hands?
No, that's several standard deviations into the tail, and it didn't last long. When we saw that, there were a unique set of circumstances that came together. People were concerned that there would be no place to store oil, and those who had obligations to take oil needed to unload those if they didn't have access to storage. So a unique confluence of events there that we wouldn't test for negative pricing. But we do test at prices well lower than where we are today.
Like $20 a barrel?
Yeah, what we shared with our investors was $30 for multiple years. And that's well below the level that the industry would the reinvestment economics at $30 are not very attractive, and so you would expect supply to gradually dry up, and that $30 is probably not a sustainable price for the long term. But certainly, if we saw demand soft for multiple years, that's a scenario we want to understand what our company looks like, and look, it's not fun at $30, but we can. We survive, we pay the dividend, and we still compete at that level.
Okay, so in listening to Michael Wirth, I get a couple takeaways, basically, from what he is saying. Number one, and this is what I like to hear, the dividend is his top priority. It's not only his top priority, I think through the history of the company, it's always been a top priority, paying and growing the dividend. Okay, that is absolutely crucial to the whole investment thesis here. Second thing is he made reference to the strongest balance sheet in the industry. I think that is true also, and we're going to be taking a look into the financials in a second. So the takeaway from that is, number one, they want to keep the dividend. Number two, they have the financial wherewithal, even at low oil prices, like he said, sustained $30 oil for a long period of time, they can still maintain the dividend. And, realistically, I don't believe that's going to happen once the economy recovers and air travel starts again and people start driving again and getting out of their homes and the economy starts growing again. I think oil prices are going to, rise, maybe not immediately, but certainly at some point in the future. Okay, so the next thing I want to do is let's take a look at the 10Q, which is the quarterly financial reporting that the company is required to do to the SEC. And let's take a look at that right now. Okay, so here you see the consolidated balance sheet as of June 30, 2020. You can see here cash of 6.8 billion. Okay, and then we go down to long-term debt, which is 30.3 billion, and you can see the short-term debt here of about 3.7. So let's call it 34 billion of debt on the balance sheet. Okay. Now we'll go over to take a look at the quote here for Chevron. Here you can see the shares outstanding, 1.9 billion, right? You can see the price up here, 71.68, and you can see that the market cap is 138 billion. So when we look at the health of the balance sheet, we divide those two numbers, the total debt and the market cap, and we get about 25%. We get 25%. Now, for a company of this size, being only 25% leverage is amazing, okay? If you recall, or if you got a chance to see the Exxon video that I did, and if you didn't, I'll put a link at the end of this video. You can take a look at it. But Exxon, we figured out, was between 35 and 40% leveraged. Okay, and that is also very, very strong. So you can see that Chevron's balance sheet is even stronger than Exxon. Now there's one more thing I wanted to do. Let's take a look at the stock chart. And here you can see the stock chart. You can see all year, this shows primarily since June, it's done nothing but go down as a trend. And it's bouncing around its low point of $71.68. And, you can see historically the stock has really been beaten up. So as you can see from these numbers, it's pretty clear that Chevron, even more than Exxon, has an incredible fortress balance sheet that is more than able to defend the dividend, to pay the dividend, and if need be, they have an enormous amount of borrowing capacity to defend that dividend through this difficult period. So now I want to, as like a special bonus, go to Paul Sankey, again as I did in the last video, and he has a very interesting idea that I'd like you to ponder, and then we'll come back and I'll give you my thoughts on it.
Oh, how the mighty have fallen. Just 7 years ago, Exxon Mobil was the world's most valuable company. But just yesterday, one of its biggest competitors, Chevron, overtook its market capitalization. It was a short-lived move, though. Exxon had a 5% gain today, helping it reclaim its top spot as America's biggest oil company. But our next guest is out with a big call on both of these names. He says these two energy titans should merge. Let's bring in longtime oil analyst Paul Sankey of Sankey Research. Paul, great to have you with us.
Thanks for having me.
I mean, this would be, talk about a mega deal. I don't even know where to begin. What would a combined company look like?
Well, they're about 130 billion, 140 billion each now in market cap. And as you know, Exxon formerly was about 3 times the size, 4 times the size of Chevron. And when I say recently, as early as only this year, January of this year, Exxon was double the size of Chevron. It would be a very, very big U.S. oil company, but it would also be one with a tremendous amount of balance sheet power. And one thing we like about the idea is that if Chevron was to take control, you could get better on the ESG front and really get rid of a public relations problem at Exxon Mobil, where it's perceived to be, for better or worse, well, certainly for worse, but rightly or wrongly, I should say, environmental public enemy number one. Exxon has a huge public relations challenge, and one solution might be, to end Exxon.
Okay, so a combination of Chevron and Exxon, it's an interesting idea. It's something that certainly makes financial sense. Just in looking at a merger of the two companies, you could get a lot of cost savings, you could create a lot of efficiencies, you could eliminate duplicative businesses, etc., and you would have a behemoth oil company that would be just a sight to behold, so to speak. I think the practicality of this actually happening is very low, as Paul said, certainly not in the short term. I think that there are egos at stake here, and the idea of Exxon Mobil, John D. Rockefeller's company for hundreds of years, just going away and getting swallowed up by Chevron. I mean, that is just probably for many people, probably for everybody at Exxon, is just an unthinkable thing to have happen. So I think as a practical matter, it's not going to happen, but it's fun to think about. Now, where does that leave us in terms of a recommendation on what to do here? Okay, look, Chevron and Exxon Mobil, they're both great companies. They both pay an amazing dividend for the certainty of the dividend that I see with both companies. Exxon is over 10% now. Chevron is over 7% now. That's because Wall Street favors Chevron and is giving it a higher multiple. But let's face it, both of these companies, I believe, would make excellent investments over the next 3 to 5 years. And that's really how you have to look at such an investment like this. You can't look at it in terms of short term, because you could buy it tomorrow and it could go down some more and you'd be like, oh, why did I do that? You have to focus on the dividend, and you have to look at both of these companies as you're investing in it for the dividend. You're going to reinvest those dividends in a drip program where you're going to be buying more stock, and the dividends are just going to compound on themselves, and your investment's going to get bigger and bigger. And then at some point in the future, there's going to be the opportunity for significant capital appreciation. And that's really the way you got to look at it. Now, again, which would I choose? I would choose Exxon simply because 10% is materially higher than 7%. And I think in both cases they're going to defend the dividend. But it's really up to personal choice, personal preference. If you can't decide, you could always split the difference and buy both of them. But it is important, whichever one you buy, do access the DRIP program and reinvest the dividends. And I think that in the long term, if you do this, put it into a retirement fund or put it into some other pool of capital that you might have that is for long-term investments, you will be very happy that you did. I appreciate you coming by, and I will put links coming up on 2 videos here that you will see in a second that will provide you with additional information. And I'll also have the Exxon Mobil video that I talked about earlier in the video. And thank you for coming, and I hope you subscribe so you can be on board for the next video that'll be coming very soon.